What's going on? This is Travis from Trade with Travis, your online trader mentor. And in this video, what I'm going to end up doing is teaching you how to be able to find direction the right way. Stay tuned. Let's go ahead and get started. The first thing that we got to be able to do is go through the disclaimer. Then after that, we're going to go ahead and go through the presentation. I'm not a CTA, so I'm not going to tell you whether to buy or to sell. What I'm going to do is teach you education. And from the education, you can be able to make your own informed decision. Now, understand that Forex trading involves risk. It involves risk of being able to make money. Also involves risk of being able to lose money. So please keep that in mind. And understand that past performance is not indicative of future results, which means that if you end up making money yesterday, it is not promised that you're going to end up making money today. So with that being said, I want to make sure that I end up telling everybody about what we end up doing from an everyday basis. My name is Travis Witherspoon. I'm a senior market strategist here at Carter Capital. And what we end up doing is teaching, mentoring, and creating automation systems for the everyday trader so you can be able to create generational wealth and be able to fight for your financial freedom throughout the overall markets that you end up deciding to be able to go along with. And in the midst of being able to talk to a lot of my clients, especially in the beginning, I end up finding out that they truly do not have a trading strategy, which is a 100% perfect thing for someone that's just getting started. Even for a person that has been trading for a little more than a year, not necessarily having a full diverse trading strategy all the way through may not necessarily be may not necessarily be the worst thing in the world. However, it is very important that you end up understanding and aligning your overall trading strategy with 5 separate things. And those 5 separate things is how you're going to end up finding direction, how you're going to end up locating the trends, the trending markets and consolidating markets, what's going to end up being your entry rule strategy and your exit rule strategy, how to be able to capitalize on ETAs, also known as explosive trade areas, and how can you be able to make sure that you manage your money, because managing your money is the most important thing when it comes down to any strategy that you're going to end up having. So in this video, what we're going to end up focusing in on is how to be able to find direction and how to be able to effectively use different areas of the overall market to be able to make money off of it. Now, overall, we always say that the goal of trading in general is to spot out predictable positions, to make money where you can find a low risk to high reward, and you want to win those trades at a high percentage. I think anyone that ends up deciding to be able to get into trading always has that mentality. You want to be able to make money. You want to be able to risk very little to be able to make said money. And you want to be able to win you want to be able to win at a high clip to be able to keep your confidence up. And the only way to be able to do that is that you have to be able to locate and understand direction. In order to win in any market, you have to be able to find the direction accurately. And that allows you to be able to say, okay, well, am I going to be a buyer in this market, or am I going to be a seller? If you do not know the direction of the market, you may end up winning sometimes, but you will not win consistently. So in order to be able to do that, we wanted to talk about 4 different things. I think that there's 4 different main things that you have to be able to know in order to be able to find direction, in order to be able to trade in that right direction. I think the first thing is you have to be able to understand time frame alignment. You have to be able to understand price action, and price action is something that you got to really unpack. You got to be able to know how to be able to use trend indicators, and you have to be able to use trend lines to your overall advantage. Now, with that being said, let's go ahead and talk about what time frame alignment actually is. Time frame alignment is where you end up having 2 charts that correlate with each other, match up with the same direction when you're looking at the chart visibly. So to give you an example, typically I'm a swing trader. What I end up doing is that I will end up taking a look at the market at the beginning of the week. I end up taking a look at the weekly time frame. I look at what's happening with the current direction of the market. And then after that, I end up taking a look at the daily, because the daily is telling me what is the trading zone of the overall market. And if they are trading in the same direction, then that gives you an opportunity to be able to look for a trade in that direction. So let me give you my game plan. I'm going to get myself out the way just to kind of show you a little bit of an example of this. Going back to what I end up saying. When I personally end up looking at a overall trade example, I end up taking a look at the weekly, and the weekly is telling me what is the current direction of the market overall. Is the market bullish overall? Is the market bearish overall? Or is the market in consolidation? Because that is very important news, because for some people that don't trade consolidation, you may not necessarily want to trade in that direction. But once you end up figuring out what the weekly direction is, then after that you end up going to the daily. The daily is telling you what type of zone are you in. Are you in a buy zone? Are you in a sell zone? Are you in a no trade area when it comes down to being able to trade? Once you end up locating and seeing that the weekly and the daily are trading in the same direction, now you can move on to the smaller charts to allow yourself to be able to trade. For me, my overall plan is, once I end up getting into it, a 2-hour position. And once the weekly and the daily are matched up, I will look at a 2-hour time frame to be able to figure out what is the overall entry zone. And then from there, if I want to dive in even more, especially when it comes down to indices or anything else like that, I go to the 15-minute chart and I start looking at overall action. What is happening for real when it comes down to that overall movement? I got into the market. Should I get out of the market based off of this 15-minute swing or based off of what's happening from that overall movement? Now, the reason why this is very much important when it comes down to being able to find direction is because you use time to your advantage. By being able to spot out entries early, you can be able to have time on your side and be patient in these overall directions to allow the market to be able to move. So to give you an example, let's take a look at a stochastic RSI, for example. If you end up taking a look at that overall chart, what you'll end up noticing is that if you're in the buy zone of the overall stochastic, then typically what happens is that it takes 7 to 11 candles of overall movement before you truly have a new direction change. Well, what does that mean from a daily perspective? You have 7 to 11 days of overall movement that you can be patient on that allows the market to be able to move in the direction that you think the market is going to end up moving. That gives you a little bit more comfort if you are a swing trader. That allows you to be able to be a little bit more patient if you are a scalper and you're only trying to trade in one position. If you are a person that gets a little bit too eager when it comes down to being able to make moves, then you know that within this overall time, all I'm going to do is look and say, okay, well, if I'm trading to the downside, then I only want to trade within this 7 to 11 days in zones that make sense to be able to trade to the downside. So once again, you're using time to your overall advantage. Now, let's go ahead and talk about price action. Price action is a trading strategy in which trades are executed strictly based on the asset's price action. It's a form of technical analysis, and it gives you trading that primarily talks about the price history and ignores the overall fundamental analysis. And in forms of technical analysis, the main focus on the relation of the current price is the past price and being able to project what's going to end up happening based off of that price history. So when you look at price action, I think that you have to break it down into a lot of things that you're going to end up seeing on the charts. You're going to look at ABCD patterns, you're going to look at triangles, you'll see it in wedges, you'll see it in channels, you'll see it in trend lines, you'll see it in gaps, and you'll see it in double bottoms and double tops. Now, all of these price action movements will end up telling you exactly what's probably going to end up happening with the overall market direction. So if you end up using time frame alignment along with price action, that can end up being able to give you more of a confirmation on what you're going to end up doing for your overall trading. So let's start off with the ABCD pattern. The ABCD pattern is recognized in trending markets only. Now, in consolidation, you will not necessarily see a ABCD pattern until the market fully breaks out of that consolidation. But in a trending market, what it will end up doing is giving you a clear and visible direction of what the market is going to end up being, and combining this with other trend indicators and Fibonacci's, this will allow you to be able to determine what's going to end up being your stop loss, your entry, and more importantly, your overall take profit point to see if it makes sense to be able to take the trade. Now, when it comes down to ABCD patterns, there are two different types of trends. The market only really moves in two different directions. The market only moves up and the market only moves down. In a uptrend, what you will end up seeing is the market creating a to B rally, or the start price where the market starts off at a low price and then after that goes up to a high price. Once people start taking profit, then what happens is that the market will start to sell off a little bit. And as long as the market does not break below the A, then the market will end up giving you a decent retracement that allows you to be able to get back into the market with value to be able to trade from the C to D extension. Now, the opposite of that is what happens in a downtrend movement. In a downtrend movement, the market starts off at a high price and then after that drops to a low price. From there, people find value and they start to be able to buy it up, and people that end up taking profit from those sales end up turning their sales into buys, so the market will end up getting into a retracement to where you end up finding another high price that is being perceived in the market to be able to sell it down to a new D extension from there. Now, the next thing that we want to be able to talk about is triangles. Triangles are best described as horizontal trading patterns. Triangle patterns are adaptly named because they have an upper and lower trend line, ultimately to meet at the apex of the right side, forming a corner, connecting the start of the upper trend line and the beginning of the lower trend line that completes the two corners to be able to create triangles. In layman's terms, what happens with triangles is that you end up seeing a temporary stop of overall direction of price. The market is in an indecisive area, and what these do is allow you to be able to understand that there is a brief pause in the market, and based off of the direction of that triangle, it will tell you that you will probably end up having a little bit more of a continuation or sometimes a little bit of a U-turn of the overall market. Now, there's three potential triangle patterns that you're going to end up seeing. There's a ascending triangle, there's a descending triangle, and then after that there are symmetrical triangles. A ascending triangle is where you end up having this triangle be based off of some type of bullish movement. What will happen if the upper trend line must be used to be able to show you forms of an overall resistance? So you can see that the market ended up pushing up. It ended up trying to be able to break this overall resistance. It ended up falling, basically ended up giving you basically a low price that did not break below the original price, but the second time the market tries to be able to break above, it ends up basically breaking off as well, but it stays at a high position. Now, as long as this market stays within this and you keep on having the higher highs with being able to have a resistance, once that resistance is broken, then that means that now you can continue starting to be able to trade from there. Now, essentially what happens is eventually the buyers end up losing patience and they end up rushing into the trade once the resistance end up breaking. But one general rule that I always say is this: once the market ends up breaking out of a overall resistance area, typically what will happen is it will turn that past resistance into future support, also known as a retest. So once the market ends up retesting this overall area, that is your area to be able to get in with a trend line break or anything else like that to start being able to look at being able to buy in the overall direction of what the market will end up being. Now, once that, in this case, the market will end up being bullish. Now, the opposite of a ascending triangle is a descending triangle. Descending triangles are typically bearish formations and bearish continuation formations. What happens is that they're connected by drawing a trend line that connects to a series of lower lows or lower highs, and the second horizontal line basically connects to the overall support of the market. And just like with the ascending triangle, the market has tried to be able to break out of this area, and it taps on this area multiple times, but has not broken yet. Essentially what happens is that once this market ends up breaking the price, it will break below support and it will give you a clear indication that the market is going to end up being bearish. Now, just like with an ascending triangle, we end up saying this: you do not want to chase the breakout unless you end up catching it right at that point. Typically what happens is that the market will end up breaking out, and then after that retesting over in this area. If you look at this wick that ended up happening right here, this wick basically ended up going back up from that past support, turning into a future resistance, and then after that the market continued to be able to move down. So it gave you an opportunity to be able to get into the market without having to be able to fight with everybody else and being able to chase to be able to have a lower price that wouldn't allow you to be able to make profit very early. By finding moves like this early, this allows you to be able to create profit and be confident in the overall continuation of what the move was going to end up being towards the overall downside. Now, the next one is a symmetrical triangle. Now, unlike a asymmetrical triangle or ascending triangle or a descending triangle, there's no true direction given to you as a context clue that the market is going to end up moving. What ends up happening is that symmetrical triangles occur when a security's price is consolidation in a way that generates two convergent lines, or two convergent trends. So you end up having the market break up to a resistance, fall down to a support, and then after that ends up falling down to a lower resistance and a higher support, a lower resistance, higher support, lower resistance, higher support. The market consolidates for a while, and then typically what happens from this overall outcome is that it gives you two different directions on where the market could potentially move. Now, by being able to understand that allows you to be able to say, okay, well, when I get into a market like this, all I need to do is be patient and allow the market to be able to make the direction for me, or allow me to be able to see what the direction actually is. Now, sometimes it can be able to give you a fake out, but potentially what happens based off of this movement is that once you end up seeing the market break out of one direction and then after that retest, you truly have to see if the market's going to hold. and stay in that overall direction where it ends up breaking out. So if it breaks out to the upside and the retest is turning past resistance into a future support, then after that you have an opportunity to be able to look at buying. However, if the market crashes down and then after that breaks the support of the overall move and then turns that into a future resistance, then after that, now you know that you have to be able to trade on the downside. So this one can give you a little bit of headaches, especially in a market where it may not necessarily be a lot more decided about what's happening with the overall direction, but it does give you a two-way out on being able to say, okay, well, if it does break up, then I'm going to trade this in one direction. If it does break down, then I'm going to trade this in the opposite direction, and I need to stay out of the way until this market actually ends up breaking from one of those positions. Now, keep this in mind. This is very important when it comes down to triangles because of this. When you're trading in consolidation, you always want to understand that you're really not trading in a high probability area. Typically, the rule is that you want to buy at support, you want to sell at resistance, and then everywhere else in the middle does not matter. Triangles are pretty much the same way. You want to buy at support or you want to sell at resistance, but you know, just like with a ascending triangle or a symmetrical triangle or anything else like that, they actually start to converge and the price actually starts to be in the middle. So really and truthfully, you're only giving yourself a 33% chance to be able to win if you're trading in the middle of that direction. Now, you wait for the market to be able to break out in one direction, then after that, it gives you a little bit more of a higher percentage chance of being able to win because you're trading with people and the people have already determined what direction the market is gone after being able to break out, then being able to retest that overall area to allow you to be able to have confidence in entering the trade in the area where the market actually ends up breaking out. Now, let's talk about wedges. A wedge pattern is usually characterized by converging trend lines over a period point in time. These patterns may be considered rising or falling wedges depending on the direction, and these patterns do a very good job of being able to spot out reversals. Now, when you look at triangles, they give you a very good idea about what's happening from a continuation standpoint. A wedge tells you what's happening when it comes down to the market going in the opposite direction. So as stated before, there are two different potential trading or basically wedges type of directions. There's a rising wedge and then after there's a falling wedge. Now, once again, these give you basically a opportunity to be able to figure out what's happening when it comes down to the opposite of that overall move. A rising wedge will end up giving you more of a direction of the market falling, and a falling wedge will end up giving you more of a direction of the market basically end up pushing up to the upside. Now, with a rising wedge, what ends up happening is that it's a technical indicator suggesting that a reversal pattern will end up being frequently shown to be a bear type of move. Now, based off of that, what you'll end up seeing is that you'll see decline in volume, and basically what will happen is that it will signal a trend in the reverse of that continuation of a bear market. Now, when it comes down to rising wedges or any type of wedge in particular, you have to be able to understand this. Wedges do not often need confirmations to be able to break out in an overall direction. It's always very important to be able to see that when you're looking at that overall movement. And I'm jumping ahead a little bit, I'm sorry, but here we go. When you're looking at a rising wedge, I want you to think of a rising wedge like a roller coaster. Essentially what happens on a roller coaster is that once you end up getting on, the roller coaster has to be able to get up to a peak height before it can truly start to be able to give you that full momentum and force of being on that roller coaster. Typically, the higher the overall move of a roller coaster, the faster that it's going to end up going when it comes down to its energy going down. It's the same thing with a rising wedge. You will end up seeing the market start to go up in high prices, and then after that, look like it's just rising. You will start to see the decline of overall volume, and then once it reaches peak point, and once you end up seeing the counter trend line break, then after that you will see an explosive movement to the downside, i.e. just like how you end up looking at a roller coaster being able to move when it comes down to its rapid pace. Now, the opposite of that is a falling wedge. Essentially what happens with a falling wedge is that the market may end up moving in the overall downside direction over time, but what happens is that the prices start to converge as basically the prices start to slide and loses this overall momentum. Now, based off of the declining rate of people actually being able to get in for us being able to sell, you would start to see that buyers will start to be able to get in, and then once the market ends up breaking from that wedge, it will give you a significantly higher price to be able to work off of. Now, the equivalent of being able to take a look at a falling wedge is kind of like being able to look at a spring that you end up pulling out of a pin, or a spring that you end up basically pushing down and being able to work off of. The reason why I say that is because that you see that the market basically ends up compressing with price. The market ends up going to a resistance, falling to a support, has a lower resistance, fall to a support again, has a lower low, has a lower high, and then after that the market starts to slow down. You can see that the overall momentum to the downside has slowed down, and then after that you end up having a huge breakout to the upside. Now, once again, the typical rule is that once you end up seeing the market break out, you want to be able to catch the retest of this movement. Sometimes you may not necessarily be able to catch it, but in this case, you could truly see that this first green candle that broke out of the candlestick ended up having that full breakout of overall movement. Typically, you don't want to chase it until the market ends up retesting that area in which it turned past resistance into a future support. Now you have an area of being able to get into the market without having to be inside of that consolidation range of a falling wedge. Now, let's go ahead and talk about channels. Channels are a powerful yet overlooked charting pattern that combines several forms of technical analysis to provide traders with a potential points for entering and exit trades, as well as being able to control your risks. A channel consists of at least 4 contact points where you need at least 2 lows connecting with at least 2 highs in the market to be able to give you a full range when it comes down to being able to take a look at it. So there's 3 different types of channels. Channels have ascending movements or ascending channels. There can be descending channels, and then after that, channels that have equal highs and equal lows will end up being a horizontal channel, or we like to call box consolidation when it comes down to that movement. Now, once you end up taking a look at those overall movements, it gives you, or going back to what we end up talking about with channels real quick, once you end up getting those overall movements, it allows you to be able to know in the ascending triangle, we know that we're interested in being able to buy. We only want to be able to buy the lows of where the market ends up touching on the trend line. So the trend line that you end up creating is going to end up being very important on how you end up determining where the next price is going to end up being. And once you end up having a counter trend line break, now you can be able to enter the market with confidence based off of being able to hit that ascending support or that descending resistance or anything else like that. When a market is giving you equal highs and equal lows, then essentially what you can be able to do is that you can either buy it at support and then ride it up to resistance, or sell it at resistance and then buy it at support, or just wait until the market fully breaks out of that channel so you can be able to know exactly what the overall direction of the market is truly going to end up being. Now, with that being said, we've been talking about trend lines a lot, and trend lines are very important in the way that you end up being able to determine what the trend actually is, or determine that, hey, once we end up knowing what the trend is, can we be able to get in at a value price, either buying or selling? Now, trend line is a line that's drawn through a chart that shows the overall trend, and traders use this information to determine whether to be able to buy or sell in the direction of that overall trend. Now, there's 2 different types of trend lines. There's a trend following line, and then after that, there's a counter trend line. A trend following line allows you to be able to determine the overall trend, whether if it's bullish or bearish, and it tells you what direction that you need to be trading in based off of where the candles are. If the candles are above the overall trend line, then that means that you're looking for either bullish movement or buying movement within that. If you notice, the way that you can be able to draw this out is by starting off at the fractal low, or starting off at the lowest wick, and then after that connecting it to the second lowest wick that ends up happening from that movement. From there, you can start to project your trend line from there. Essentially, what this gives you is a line that does not need to be crossed, or a line that doesn't, or a line that if it does get crossed, it changes the overall trend direction of what you should be doing for buying or selling. As long as the price stays above this trend line, then I will only look at being able to buy based off of this movement. If the trend line is actually below, when it comes down to this movement, now you're looking at an overall downtrend. Now, to be able to draw a downtrend, then you start off the highs of the wick and you go to the next connecting wick, and then after that you just project it from there. As long as price stays below this overall trend line, then you only should be looking for sell trades. Once it breaks out of that position, then that means that you need to stop having your overall mindset from being bearish to now being bullish. Now, we talked about being able to have a trend following line, but more importantly, when you have a trend following line, you want to be able to use counter trend lines to your overall advantage. A counter trend line targets a temporary correction in the overall trending securities price action to be able to start looking for overall profit. Now, this strategy involves being able to take a look at what's happening with the overall market. Once it ends up reaching up to a high price, the market will start to be able to fall back to that trend line. Once the market ends up falling back to that trend following line, and then after that you can start to see that the market is making more of a U-turn to the upside or a U-turn to the downside, and it breaks the overall trend line, then that allows you to be able to get into the market with confidence, saying that the market will continue being able to move in the trend that it was previously doing. Now, the benefits of being able to have that is giving you more trading opportunities with less drawdown. Once again, it goes back to the overall goal of what trading actually is. We want to be able to find high probability trades that's going to end up allowing us to be able to risk as little money as possible to be able to make as much money as possible and be able to have the confidence of being able to take it. So to give you some examples of what trend lines look like, let's talk about, on the left side, let's talk about a bullish counter trend line. We can truly see based off of our trend following line that the line is bullish. In order to be able to create a counter trend line, what you would end up doing is that you will go to the peak movement of that opposite fractal. So in this case, the market is bullish. You want to look for a fractal high. We can see that once we end up getting this fractal high, that the market is starting to basically descend in overall price. The market is starting to move to the downside. So what we end up doing is placing in our counter trend line at the top of the wick, and we end up connecting it to the next time that it touches that wick. And then after that, placing a guideline below. Until this market breaks above this overall line, then we would not look at being able to enter when it comes down to this price. Now, we have two things when it comes down to confirmation. We have the trend following line saying that we should be looking at buying bullish trades only, and we have a counter trend line that's basically telling us that it's okay to be able to get in once the market price has closed above the overall candlestick. So if you look at it, this green candlestick closed above with that wick, but we would not enter in until that second candlestick to allow us to be able to get into the trade from there. And you can do it multiple times. You can see that this gave us 4 different opportunities. High price connected down to the low price, the market ended up touching the support line. Either we got in when the market ended up hitting the support line. If we wanted to be conservative, we wait until the market closes above. Then after that, we enter from there. Same deal, market is getting away from the trend line, but we have a counter trend line break. Market closed above, we entered off the next candlestick. We end up doing that again, the market ended up pushing up. Now, is this the exact science? No, but it will give you chances to be able to have no areas where you can be able to have a sound stop loss that's going to risk you a little bit, and a take profit that will allow you to be able to go out there a little bit more. Now, to draw a counter trend line bearish, you do the complete opposite. We know that our trend line has to be above. Our long-term trend follow will have to be above, and then from there, once the market starts creating fractal lows, and from that fractal low, we end up connecting it to the next fractal low, or that next wick, we can be able to draw lines up. Now, once the market ends up breaking that counter trend line break and closing below, now we can enter at the next candlestick and be able to ride the price from there by being able to place our stop loss and being able to place our stop loss in a position to where we can be able to have a very low risk versus reward. You can see that it happened a second time. The market broke below the candle. It gave us an opportunity to be able to get in. And now you end up seeing the price truly fall down based off of that counter trend line price. So counter trend lines give you multiple chances to be able to get into the market freely with being able to use overall price action to help you understand what the direction of the market is going to end up being. Now, the general rule when it comes down to counter trend lines is that once a counter trend line break is broken, it will end up gravitating to the next trend line. So typically what I end up doing is that I end up doing 2 different trend lines. And the first trend line is known as a outer trend line. In the outer trend line, what happens is this. You end up connecting the fractal low to the next fractal low. You end up projecting your overall lines out. What that does is tell you the long-term trend line direction. As long as the market stays above this long-term trend line direction, then that means that we're only looking at bullish opportunities. Then from there, you can be able to draw a more aggressive trend line. That more aggressive trend line is known as a inner trend line. So that goes from the last time that the market touched, or the second time that the market touched, and then after that you connect it to the next lowest wick from there and then project up. Now in this case, with the aggressive trend line, you will end up seeing a trend line break faster than what you would see with the outer trend line. So this gives you an opportunity to be able to get in, not necessarily risking a lot, but once you know that this market breaks the inner trend line, typically what happens is that the market will gravitate toward the outer trend line. And once the market gravitates toward the outer trend line, then you will end up having a test area. In this test area, the market can either do two different things. The market can either keep on falling down to the downside and truly have the trend change, or this can be an area of natural support and the market will continue to move based off of the outer trend line. Now, if the market ends up breaking the outer trend line, then that is telling you that there is a true direction change in the overall market, and you should look at only being able to trade within that true direction change first before being able to decide to be able to get back into the market in the opposite direction of where it was. Now, with that being said, let's talk about what happens in the market. And typically, sometimes it doesn't necessarily happen a lot, especially when it comes down to Forex, but it happens in stocks all the time. What you'll end up seeing are gaps. Now, gaps are areas on the chart where the market price of a stock or any other financial instrument moves sharply up or down with little to no trading in between. As a result, the assets chart will end up showing a gap of the normal price pattern. Now, typically what happens, or typically this happens at the open of the market, especially when it comes down to stocks, or at the open of the market when it comes down to Forex on Sundays when the market has just opened up. Now, why does a gap actually happen? If I want you to kind of understand it like this. When it comes down to traders, as an individual trader, we do not have the opportunity to be able to trade when the market is closed. Now, market makers, large banks, large institutions are able to do so. So they can be able to take advantage of the price and be able to drive the price up before the actual general public can be able to make trades in that overall area, thus giving you a large push up in one direction before anybody else is able to see it or make any action when it comes down to the trade. Now, if you notice, what you will end up seeing is generally what happens is that the market will end up breaking or being able to create a gap. Once it ends up creating a gap, typically what happens is that once the gap is there, the price will end up being filled. Now, eventually the price will end up being filled. It's not guaranteed that it will end up happening within that next few hours or anything else, but once that gap is filled, it will typically act like a level of support in a bullish trend or a level of resistance of a bearish trend. And once that gap is fulfilled, now the true trading actually happens from that overall position. Now, once again, just like what I end up saying, when a gap is created, typically the market will end up filling that gap first before being able to make a move back in the direction where the market actually went. Sometimes the market can be able to fulfill a gap, and then after that, it can be able to start to be able to move in the opposite direction of that overall gap, based off of that movement as well, depending on what's happening with financial news or any type of overall chart movement when it comes down to that direction. But you have to keep that in mind when it comes down to being able to trade. Now, the last price action thing that I truly believe that anyone should be able to look at is what's happening when it comes down to a natural reversal of the overall market after a full downtrend or after a full uptrend actually ends up happening. And typically what you end up seeing, especially when you look at indexes, you will end up seeing that the market will end up either making a double bottom or a double top. Now, a double bottom pattern is a technical analysis chart pattern that describes a bullish change of trend and a momentum reversal that goes from the prior leading direction of the action. What happens is that a double bottom ends up making the letter W at the bottom because what happens is that the market will end up finding a support price, will end up pushing up again, and then after that falling back to that same support price. And then once it falls back to that same support price, then what you'll end up seeing is more people have more confidence of being able to get into this price line, especially after the market ends up breaking the neckline of that overall movement, and then after that starting to be able to push up in the opposite direction of the trend. Now, double bottom patterns always follow a major or minor downtrend. In a particular security, signals basically end up showing you based off of a double bottom that this is the new start of a new trend that's going to end up happening. So if you end up seeing the market have a abruptly large move to the downside, and you can see that the momentum is starting to change, the market ends up hitting the first support, the market tries to push up, sellers try to sell it back down, and the buyers reject it in the same area, then typically what you will see is the market will start to be able to make a U-turn pattern to the opposite direction, once again known as a double bottom. Now, the opposite of a double bottom is a double top. A double top is an extremely bearish technical formation that forms after that asset basically reaches 2 consecutive times of a high resistance price and has been rejected. A double top, unlike the double bottom where it makes a W, actually ends up making an M, basically showing you what the overall resistance level is, and it gives you a new trend, or it tells you what the trend is going to end up being. Now, I always say you can be able to look at this in 2 separate ways. One, you can be able to enter in based off of the neckline once the neckline ends up breaking, or you can enter in based off of the trend line, based off of aggressive trend line, and seeing that the market ends up breaking a counter trend line breaking, going to the downside after rejecting the second top. By doing this, this gives you an opportunity to be able to get into the market and be able to start being able to make the moves a little bit earlier than someone else would, thus being able to profit off of that move a little bit more. Now, if you notice that this is actually more of a consolidation type of movement, kind of like being inside of a box channel or anything else like that, then it may almost be safe to wait until the neckline breaks, where you end up having a breakout in support, or basically end up having a breakout in a retest of the natural support, turning past support and the future resistance to get into the market and be very comfortable with that market movement. But once again, this is going to give you an identifier about what the direction of the market is actually going to end up being overall. Now, if you like what I ended up doing when it came down to this video of being able to teach you about how to be able to find direction in the right way, I would encourage you to be able to hop inside of I Do Something Now Bootcamp. I Do Something Now Bootcamp is a by appointment only bootcamp. All you have to do is go to cartercalcapital.com/start here. Be able to sign up for that overall bootcamp. And basically what this is going to end up doing is letting you know and being able to go inside of a free webinar to where it's going to end up showing you what we do from an everyday basis when it comes down to being able to spot out direction, being able to spot out explosive trade areas, talking about everything that we end up doing from a Fibonacci standpoint, and more importantly, being able to talk about what we do from an automation standpoint to be able to increase your overall trading and be able to help you out when it comes down to your overall trading journey. I would love for you to be able to hop inside and be able to get more information about that when it comes down to everything that we do from a trading perspective, and also be able to allow you to get the most out of your overall trading career. I think that more importantly, the best thing is being able to find a mentor that has went through all of the fires that you're trying to go through and be able to put yourself in the best position possible to be able to do that. In order to be able to do that, I would love to be able to help you out. You go to cartercalcapital.com/start here. All you have to do is just sign in by placing in your email address, first name, last name, phone number. We end up contacting you and setting you up for your free trading bootcamp that will lead you into our Do Something Now trading bootcamp and some of our new courses that we're going to end up basically pushing out for the rest of this year. I'm very excited about what we have coming up overall, and I'm very excited for you on being able to watch our next videos that will help you out in building your overall trading strategy. Like always, make sure that you end up planning your trade. Make sure that you end up trading your plan. Well, I will see you in the next time that we end up having our next video. Take it easy.